In this video, traders, we're going to look at, is hedging a better alternative to using a stop loss? Stay tuned. Hey guys, a warm welcome to you. Alright, so this video is sponsored by Core Spreads Australia. There's a link to those guys in the description below. Go and check them out to see if they're the right broker for you. But what I want to talk about specifically in this video is hedging versus using a stop loss. So we've all been there, got a trade, could be in our favorite market, favorite index, favorite currency pair, commodity, stock, whatever it is. Market's moved up, and let's say we're long, nice trade. Market moves up, we want to kind of lock in some of those profits. We want to take profits just yet. So we move the stop loss up, lock in the profit, stop it reversing on us, comes back, just pings us out, and then maybe carries on. Obviously there's ultimate different scenarios like that, but there's scenarios where you've thought about, hey, is a stop the right thing to do? It doesn't seem like it's the most effective tool, and it might not be. So let's explore that now. So in this example, we're looking at the US indices. So we're looking at stuff like the NASDAQ, we're looking at stuff like the Dow, the S&P 500, potentially the Russell, any of those US indices, the major ones. And yes, this is my kind of beautiful drawing, guys. I know you appreciate this. But if we imagine that they're trading, chugging along, and you are long the stronger index, okay? And not necessarily you picked that because of that, you're long because of whatever setup. And what you're trying to now do is, in the case of a long, we want to find an index or a correlated market that's weaker. So if we're long, whatever market we're trading, whether it's an example here, a US index, or whether it's a commodity, anything that's correlated and that's weaker if we're long or stronger if we're short. That's what we're looking to do. We're looking to find something that is exhibiting something different to what we want. Okay, so if we're trading, let's say we're long the NASDAQ, now we look for something that's a potential hedging market that's correlated. Dow, check, it's correlated, reasonably correlated. I'm going to get 100% correlation, of course, guys. But something's reasonably correlated. Like the US indices, S&P 500 moves pretty much like the Dow, like the NASDAQ. Yes, they kind of go out of sync from time to time, but it's going to be is what it is. And we look for something that's weaker. And how do we identify weakness? Well, we can simply look at how much it is from our anchor point. An anchor point could be the start of the trading day, could be the start of trading month, start of trading quarter, whatever time frame we're trading, and using that as a kind of a benchmark for weakness. It's not perfect, I get it, but it's a kind of a good arbitrary point to look at. Okay, so let's imagine this is it. Let's imagine this is an intraday chart, for example, and we're long the NASDAQ. We've been long from whatever, let's say we've been long from kind of this point here, everything's nice, it's chugging up, and we start to consolidate here now. And then we start to break out of a range up here. So we go, right, we've got another secondary breakout. I want to start to bring my stop up. So if we were trading normally, we might bring our stop loss up to this point here, right? Just under that resistance, we've broken out of there. If it's a fake out, it's going to come out, it's going to ping us out. We want to lock in this kind of profit potential here. Now, we've identified that the Dow is weaker because not only can we see that it's not up as much at this point in time, but we can also see, and this is a little trick, guys, is that, we see the patterns and how the weaker market reacts compared to the stronger market. And this is what generally would happen, is that when we're in a kind of range or pullback state, the weaker market will have a deeper pullback than the stronger market. And that's a little telltale sign sometimes. And the same with the breakout. It's the same with certain circumstances. And later on, we'll jump the gun a bit now, but things like this, you might get a double top here, but you might get a lower high on the weaker market. So at those key points, that's where you're distinguishing strength from weakness. But anyway, let's imagine now we have this stop loss here. Now, ultimately, it comes up later on in the move. We go to new highs here, fresh highs. Market comes down. It would stop us out here under normal conditions. So I've got something that's slightly better. So let's say, for example, we identified the Dow was weaker. But let's say, for example, instead of us trading the NASDAQ just raw and naked, long out, let's say, for example, now we started to initiate a short where we would have our stop loss. So in other words, okay, market's kind of chugged up along here, market starts to come down here, market would stop us out normally here. Let's say now we're initiating a short on the Dow. Now, because generally it's weaker, what we're hoping to happen is we're hoping that it keeps us in the NASDAQ trade but hedges us for a moment in time. So this would be if we perceive that this was just a bit of a shudder and then later on we're going to get a further move. And obviously if we want out of the trade completely, then fine. But let's say we want to kind of minimize the loss on a downturn. What we're effectively doing here now is we're shorting the weaker stock and we're long, or the weaker index should I say, and we're long the stronger index. So And we've started to gauge this because we've seen deeper pullbacks on here versus a consolidation here. We've seen a lower high here versus a double top here. So all exhibiting strength, and obviously the absolute number change from here to here. Now, if we're initiating a short here, the idea is, and of course it's not always work all the time, guys, it's something for you to look at and kind of tweak and adjust to suit your risk parameters, is that, you know, this is going to fall down. We're going to be losing money on a long position, but we're going to be gaining money on a short position. And the theory is that because this is the weaker instrument, we will gain more on the short than we will the long. So what this does is it effectively neutralizes our position a lot more than it would be obviously just being naked long. So if we didn't have the stop there, we'd be losing all our amount, whatever pounds per point we're trading at. But if we've got a short position there, it's offsetting some of that loss. And the theory being that this short is the weaker market is going to fall heavier than the long. Okay, so we're going to make more on that. And we're not going to be as vulnerable. Actually, if we don't make anything, that's fine. But if we're shorting the weaker one, then hopefully we'll make a little bit, a tiny bit. But the thing is, it keeps us in the trade. So if we do get some kind of reversal, let's say it was a fake out from there, and now the Nasdaq starts to rip up again. Okay, as the market starts to rip up again, and we're looking to maybe take it back on pure naked long as we, let's say, go through the highs, for example. Okay, so we're hedged all the way up to there. The Dow may only, because it's weak, might not even break to high. So now we can roll off the short and we can stay with the long. And what it's done is, it's number one, it's kept us in the deal. So we've not been stopped out on something that we wanted, a longer term thesis. Number two, we might have even made a little bit out of it. You know, instead of being not in it, we might have made a little bit out of it. And that's the idea, is that, you know, we've made a little bit more on the short here. And number three, from a psychology perspective, now we might be, you know, someone might astutely be saying, well, there's no difference to us coming out here and then going back in here. That might be the case. Hopefully, again, we're going to try and make some more money on the weaker as well, being short the weaker and long the longer. But what it does is, from a mental perspective, is that you know that once you're out of the trade, often it's very hard to go back into the trade, especially if you're buying again at fresh highs. Whereas if you're already in this trade, holding for fresh highs, for some reason becomes much easier. You're like, well, it's a breakout, it's going to continue on. So there's a psychological benefit of doing this. And appreciate, yeah, I can stand here and say, oh, you just short the weaker when you make money when you're going short the weaker. And, you know, I get that in the real world, it's not as easy as that. But it's something to perhaps look at and consider. So not only from the mental perspective of being able to stay in trades for longer, and yes, this might not always work out in your favor, and it might just be just the same as kind of hitting a short here and going along there. But if you're staying in the trade, it allows you to hedge the risk. And ultimately, you know, let's imagine this thing just falls through the floor, you're not losing anything. You know, you're not going to lose anything, because if you're in a correlated instrument that's moving in sync reasonably well, you've still locked in that profit that you've made from the naked long of Nasdaq. So you're ultimately still protecting your downside, but you're ultimately as well, hopefully if you're positioned well, putting yourself in a position to be able to peel off that hedge for a further move up. And yes, you're still going to have to time the market. It's not holy grail, it's not a magic pill. This can't just go, oh, well, I'm just going to hedge my way into profit. It doesn't work like that, but it might be a little hack to consider to help your kind of mindset and ability to hold the trades longer. It might be, you know, allow you to hold a trade to maturity, and maybe benefit as well from kind of a little bit of a pair trade opportunity there. So there's a lot more things to look at. And when you're trading stuff that's got reasonably tight spreads, like these US indices or even some of the European indices, then it becomes potentially a feasible strategy, because you're not paying a huge spread to actually put this hedge on. So anyway, guys, go and check out the Core Trader 2 platform from Core Spreads Australia. There's links to those guys in the description below. Like I say, they are sponsoring this video. If you like this kind of stuff, a thumbs up's appreciated. Take care, keep the risk managed. See you in the next one. Goodbye.